Back to another video on the channel. Today I bring to you very important tax optimization that can help you reduce your taxable income each year by rupees 1.25 lakhs. This is on your stock sales and mutual fund sales, the capital gain ones. So yeah, let me share the strategy with you. But before diving into it, I would urge you to please subscribe to the channel. That will motivate me to make a lot more such content and spend more time on researching for these and making this more numerical and more help you understand this more. And please do share with people you think this might help. So yeah, let's just dig right in and please help a creator. Thanks. So what is the biggest enemy of compounding? Most investors focus on returns but ignore the biggest silent killer, which is taxes. Whenever you sell a mutual fund unit or some shares, you have to pay certain tax on it. Like you have LTCG, which is 12.5%, and STCG, which is 30%. So let's see how we can optimize on these taxes and make more out of compounding and save our money. So one rule that you must know is that equity LTCG, that is long term capital gains in India, how do any sell qualify for that? So the holding period must be more than 1 year and the taxation on this is 12.5%. But the most important details that a lot of people miss out on is that first rupees 1.25 lakh gains equal to zero tax every year. So on the first 1.25 lakh profit, that is LTCG, you'll be paying zero tax. This 12.5% calculation only starts after profit of 1.25 lakhs. So the optimization is for people who are earning like profits of these like 1.25 related numbers every year, and this tells you how profit harvesting can make a lot more sense for you. So let's understand the real problem. If you do not use this rupees 1.25 lakh exemption every year, you cannot carry forward it. Like the next year I cannot get a 2.5 lakh exemption. So how do I use it this year and the next year and the year next to it, and how do I make sense of it? So most investors waste this exemption. We need to be different. So let's understand the simple strategy to pay zero tax before the end of fiscal year. Like the usually how you do your investing, do it that way. But before the end of this fiscal year, sell shares that bring your total LTCG to 1.25 lakhs. So you can check your like if you're using Zerodha or anything like that on console, you can download the PDF and see your tax profit gains for this year. And you need to bring it up to 1.25 lakhs, that is like the zero tax limit. Now what you can do is like sell those shares that take your profit up to 1.25 lakh and buy those shares back the next day. So you're basically resetting the value. Like if I bought a share at 300 and I sold it at 500, booking a profit of 200 rupees, I am still keeping it under the 1.25 lakh total profit booking limit that pays that makes me pay zero tax. And like since I bought it the next day, my price is somewhere around 500 rupees. So my price is reset as well every year. So your cost price is reset and you need to repeat this every year. So like this is not a problem with compounding because I'm buying the same share the next day. If I have conviction that this share will give me heavy returns in next 10 years, I am going to keep that share, but I'll just sell it every year and buy it back the next day, so that like while I continue my compounding journey, I also save some taxes on it. So let's understand like how much tax can be saved on this. So let's use a profit harvesting strategy. So like by selling mutual funds, like the equity based mutual funds and my normal shares, I am booking a profit. So like basically year zero is when I started, and now every year I'm booking 1.25 lakh profit once this is LTCG, that is 365 days have passed after I've bought the share. So I booked a profit of rupees 1.25 lakh in the first year, I pay zero tax. I've done the same in the second year, I pay zero tax. I've done the same in the third year, I pay zero tax, and so on till the 10th year. So basically I've booked profit worth 12.5 lakhs in these 10 years, and I've paid zero tax on this. So this is the profit harvesting strategy. Now let's look at the same like keep long term and then sell strategy. That okay, I believe in this stock, which I did in the profit harvesting one as well, and I'm going to sell it together after 10 years. So let's say I booked zero profit, 0 0 0 0 0, and the last year I booked a profit of 12.5 lakh. So let's deduct 1.25 lakh exemption on in the 10th year, and let's say that okay, the total profit that I'll be earning on this will be 11.25 lakh. And when I calculate tax based on LTCG, that is 12.5%, I'll be paying 1.41 lakh. And it's possible that the long term capital gains percentage, that is 12.5%, has increased by then as well. So that is another loss. So in the first profit harvesting strategy, we paid zero tax, while in this strategy, we're paying 1.41 lakhs, which we could have saved and compounded more. So yeah, let's move forward. So yeah, there is obviously an edge case to this. Say I've been selling this. So in the first like profit harvesting based algorithm, say I have held a share for like 3 years. So I've sold it in first year, second year, third year, and now I want to sell it in the middle of the third year because I have some emergency. In our second case, the normal case where we keep it long term, it's not a problem because since it has been there for 3.5 years, it is LTCG. But now in the profit harvesting algorithm, this becomes STCG. So yeah, emergencies come unannounced. This is a fair concern. Let's see like how our strategy still works. So case one was that the share was in loss from last sell value. So say in the third year I sold the share at 500 rupees, and today when I have an emergency the share is at 450 rupees. Since I made like a loss in this short term, I'll be paying zero STCG on this, right? And like even my LTCG will be calculated on the 450 and difference from the buy value. So in this case, STCG is not a concern for me. But yeah, the second case is quite interesting. What if the share rallied this year? That okay, I am booking profits in the share because in this half year the share value increased by quite a lot. So this case is quite interesting because the share has rallied and now I want to sell it, but because of the profit harvesting strategy, now I might have to incur STCG on it. So let's do some quick math. So let's consider X is the profit made till last year. So basically in my profit harvesting one, I was selling it every year. So X is the profit that I made from 0 to third year, 0 to 3, and Y is the profit that I made this year. So in profit harvesting, X had 0% taxation on it, and Y will have 20% taxation. Whereas in like the second strategy, X plus Y will completely incur 12.5%. So let's do some quick math. X into 0 because we paid 0 tax on it using the exemption, plus Y into 20 should be less than X plus Y minus the 1.25 standard deduction into 12.5, that is the tax percentage for LTCG. So I'm calculating 20Y must be less than 12.5 X plus 12.5Y minus 15.62Y. So Y must be less than 1.67X minus 2.08. Now with some error I'm going to ignore this minus 2.08, and as like the value of X and Y increases, this becomes quite irrelevant. So let's basically when the value of X increases, this becomes quite irrelevant. So let's so Y is nearly less than 1.67X. So basically, say if I made 100 rupees of profit in the last 3 years, this strategy will work unless I made 167 rupees in just this last 6 months, which is quite rare, I must say. And like even if you made a profit of 130 in just this 6 months while making a profit of 100 in last 3 years, you're still good to go, and you saved money with the profit harvesting technique. So I am pretty sure you're able to make sense of this, and the math is in front of you. So why this works? Like, what's the intuition behind that? You saved 12.5% tax on a big chunk earlier by paying zero taxes using the exemption, and you're just paying 20% on a small chunk that is like the profit in the last 6 months or 7 months. So the net result is that the strategy still saves you money. Who should be using this? It's for long-term investors who have some patience and want to keep these shares for like a few years, because only then LTCG comes in pictures. SIP investors, since they'll be keeping their since SIP builds discipline and the money is saved for some purpose or a goal. And yeah, medium portfolios where your profits are not of the range of 10 lakhs 12 lakhs a year, because then this ceases to make a lot of sense. So important considerations for this: when you are selling this regularly, you'll be paying some brokerage and STT charges, but yeah, those are negligible. But still, I wanted to call that out. One day price movement risk. So when you're selling this every year, it's quite possible that share fluctuates by a bit. So that is one consideration. And one important thing is that tax rules can change. So if LTCG keeps on increasing, this strategy at least like earns you more, because in that case you'll have saved with LTCG in the previous years. And but yeah, there are some things that can change. The deduction can go away. So that is a caution you need to take. So this is tax optimization. Final takeaway from the video: if you invest in equities and like stocks and mutual funds and ignore this exemption, you're overpaying taxes and not optimizing them. Use the rupees 1.25 lakh exemption smartly. Please comment if you agree with this, and if you want to learn anything more about this or have any questions, please comment your next video suggestions. Please share this with your friends. This will really help a small creator who wants to bring some knowledge to you guys, share some knowledge I've learned in these years with you guys. And please like the video and please show some love. Thank you, and I'll be back with another video soon.